Good afternoon, everyone. Welcome back to the discount. Today is Sunday, March 19th, 2023, and we're going to kick it off here with a daily chart of the SPY, the S&P 500 ETF, the spiders. And I think we have quite a bit to go over today. I want to make some comparisons back to the 2008 recession. I want to look at the NASDAQ. I want to look at the Russell 2000. I want to look at Bitcoin and gold and what they're all telling us right now. So, starting off with just the spiders chart here, I want to make a couple comparisons first, right off the bat. And what you can see is this trend line that started January 2022 to make the comparison to the NASDAQ when their trend line started, and then as well the Russell when their trend line started. And not to get too into the weeds with this trend line and how important it is on these other charts, because the spiders really are the most important chart right now, to me at least. However, the other charts, such as gold, such as Bitcoin, such as NASDAQ right now, and that was the 2008 NASDAQ chart, but this is the NASDAQ chart right now, the QQQ. They're all telling you something a little bit different. And I believe, and this is just reading the charts, that gold, Bitcoin, and NASDAQ are all telling you that we're going to see a rally. Now, I don't know how long the rally is going to last for, but I want to put a couple ideas in your head if history were to repeat and if history is going to be different this time. So, first, let's go back to the spiders chart. Now, as you'll notice, again, it started in January 2022, and here we are battling this line, which I said if we're up, we are bullish. If we are below, we are bearish. Now, again, we're fighting the line, and there's really nothing more to make of it, except when you look at how strong the highest beta products out there are, right? The risk taking products, the NASDAQ. Sorry, that's 2008. This is the NASDAQ, the QQQ. You have the Russell 2000, which is signaling that the banks are in trouble, obviously. Now, that is a leading indicator, and we're going to keep this on a sticky note for right now because this is showing future weakness. However, and then gold, right? Gold is a flight to safety, and this thing is rallying. Now, Bitcoin, right? The argument to be made still is that Bitcoin is a flight to safety product, or at least is maturing into that. At least if you're just purely in the crypto space, that is certainly an argument to be had. That look at everything else that has just gotten completely destroyed. Yet Bitcoin, here we are, the true orange coin, the true test of time so far in the crypto space. So we don't know if Bitcoin could outstand or last yet a severe deflationary, recessionary, depressionary environment. We just don't know that. However, it's telling us right now that the banks are failing. This is doing good. The banks are failing. This is doing good. The banks are failing. Russell's doing bad. The banks are failing. And NASDAQ is doing quite well, above all the moving averages, in a different position than the SPY from its trend line, right? This is a way more bullish looking structure, regardless of it being down more significantly from a percentage standpoint. This is definitely a more bullish structure than this, right? It is fighting this trend line still. Now, I want to take you into a little bit of a macro path here and go over something that the pros across the world use, that you should use, and that I certainly am using. And this is very macro. It is not so much a technical evaluation, but we're going to put two and two together And you'll see kind of where my head is at in the scenario that, look, all of the higher risk as well as the defensive names, right? Gold, Bitcoin, tech, and then showing weakness in the financials. This is all being mixed into a pot and telling you a story. And I believe that the story is risk on for right now, as well as the signaling the recession alarm for potentially in the near future. I mean, we are in the recession already, and I'm going to show you that right now. However, that doesn't mean that we are in the bear market across all markets that follow a recession. Okay. The bear markets that follow a recession are where the ETFs and everything get hammered down, 50 plus percent, which we just simply have not seen that yet. We've only been down 25%, 30%. So there's still a lot more to go in terms of downside from this recession. Now, when that happens, let's take a look here. So this is the January 2020, or no, I'm sorry, 2006 US Treasury yield spread from the 10 and the threes. This is a pound for pound knockout champ of when recessions actually happen. And then you can predict quite accurately, I think it's 11 for 11 out of the past recessions. So this right here is the bear market, right? The recession that followed. Now, and this is the inverted yield curve. This is the ultimate stress on a system that is reliant on the Federal Reserve and reliant on monetary policy in such a way that we have been with the Federal Reserve. When this happens, it is almost guaranteed to signal weakness ahead for all markets. And we're going to show you that right now. So this flipped to inverted on December 31st, 2005, just about. And that stayed inverted for, let's see, 22 months. And it flipped back on August 31st, 2007. Okay, well, let's take a look at what the markets did during that time. Okay, so you have a somewhat of a correction, right? This was a 20% correction, just about a 20% correction in the NASDAQ, just about. And this was during the yield curve inversion that predicted this, right? This drop was 60%. So this was the real recessionary. If you had a 401k, your 401k was down 60%. This is the recessionary bear market. Okay. This was just the bull market still leading up to the bear market that follows a recession. So here we are in a inverted yield curve environment. And what happened when the yield curve, let's go back here to the yield curve chart. What happened to the markets when it started to flip back? So here we are, February 28th, 2007. The market in February 28th, 2007, right here, started to climb. Okay. It started to climb when the yield curve started to go back to normal. And look what happened from the start of, let's go back here, from the start of this to this, you had a 27%, just about a 27% rally, right? From the time where everyone's kind of like, all right, what's going on here? The yield curve's inverted. Oh no, don't worry, everything's fine. We should get a landing. Things are rallying. And it goes down 60% from there. Okay. Now, if we look at, let's go back to the yield curve again. Okay. If we look at where we are here today, if I could zoom in here, there we go. This flipped to inverted on July 31st, 2022. Okay. Let's draw a similar line here, right? From the start of the inversion, let's draw it at about I don't know. Let's draw it at a year, okay? Because the year is the standard. If we go to this chart, the year is about the standard for how long, besides 2019, which was not valid in my opinion. It was, it just got disrupted by the flash crash of COVID, but that wasn't a recession. Now, let's take it at about a year. Now, this was 22 months from the start of the inversion to the start of a bear market, right? Or the start of um, when the yield curve went back to normal. Okay, so let's take this. Let's look at this. Okay, and let's draw another line here. Vertical line. Now, obviously, drawing another line from 2008, this thing actually went way longer. So let's call it December 2023. Okay. If we're looking at how this played out and then how this played out, okay, not saying it's an exact mirror image or anything, but I'm just going by timelines. This really has potential for a lot of upside. So let me just delete that real quick. If we go and say, I don't know how this is really going to play out, but we could do one of these, right? That would lead to a double top type of scenario, and we can then resume the downtrend of the true, right? True recession, where this is going to go down, 60%, maybe who knows, even worse, 80%. We just don't know. Now, what this is telling you right now is that this has room to fly and that the yield curve is starting to come back in to normal. And when that happens, history is telling you you should get some type of market rally. Now, I don't know how high that necessarily takes us. Let me go ahead and just give you, if I was to just remove these drawings for a second, if I was to give you some targets just from a technical standpoint, these would be the natural targets right here. So I'm going to draw just a fib retrace from high to low. Look how nicely it plays in between these lines. And I'm going to say that given this move right here to this move, if it starts chopping, first, the obvious place is 330 on the QQQ. If it wants to go and do some more, I think that this gap fill, okay, right at about between 360 and 370 is going to be a great place. That is where I'm looking to start looking for a turn in this market, is this gap fill right at, let's see, 360 or so on the NASDAQ, which also coincides with this area right here on the SPY. So it's about 450 to 460 on the SPY. Now, again, I don't know how much room this thing has to run. I mean, we could even, if we go by what happened in 2008, right? This thing ran all the way to new highs before actually busting, right? Going into bust mode. So this, we potentially do have a long ways to go before we turn and start to turn for the bear market. Okay, let's go to again the yield curve spread. So we stopped. This is again in 2005 through 2007, and then the bear market in 2008. So we stopped inverting on the yield curve spread in, let's just call it August 31st, 2007. So if we go to a gold chart, historic gold chart, so August 2007 is right here. I mean, look at the run up that we had when the yield curve stopped inverting, right, from the top. That's a 50% gain. And also, this was starting to make it first corrected, right? It first corrected 23%. If we go to the gold chart from here today, right, it corrected what? 22%. Okay. And then what did it do? Okay. Once it corrected, it went from high to low 85% until the 2008 crash. And what did gold do during the crash? It went down 30% before going on a massive, massive run that really was just historic, right? Because the Fed came in with the printer again, and we ran up 170% on gold from the bottom of 2008. Okay, so you pretty much just time up these factors, is what I'm trying to say. You look at the yield curve, you look at gold, you look at what the NASDAQ is doing and Bitcoin now, and you're putting these things together and saying, okay, well, when does the Fed truly have to pivot? The banks are starting to fail. Okay. Now, obviously, this time is going to be horrible because the inflation is through the roof. So if the Fed has to pivot and start bailing out banks left and right across, the European Federal Reserve banks, the United States banks, maybe we get like a General Electric or something that goes bankrupt. The Fed's going to have no choice but to step in. That is going to create another inflationary cycle like this. So, what does that mean for gold? Well, anything that is an inflationary hedge, a true inflationary hedge, um, right now, that's going to get a bid. I think this is a broad based rally. It's going to get a bid. And then from there, when we crash or correct in the recessionary bear market, maybe this just goes down and hits mean reversion and then goes on another epic, epic run. And I think that's probably what's going to be the case. Now, again, this is super long term stuff. Going back into just reading the charts, this is a broad based rally. Gold is telling you that there's risk off out there with the banks. IWM, the Russell, is telling you that the banks are in trouble. And the NASDAQ and Bitcoin are telling you that high beta products are on. It's game on for at least right now. And until we start to see a turn, these things are bullish, right? Bullish above the trend line, bearish below. And I think if we just, as long as we stay above this trend line, we got some room to rally here. We got significant room. Again, this isn't a prediction. I'm just reading the charts. We can do one of these and fake everyone out until, who knows? Maybe the presidential election is a good time to turn things around, right? Who knows? But that is how I'm reading this, guys. If you have any questions on the yield curve, how to read these things, do take your time and take a look at when the yield curve inverts and then the timing of when the stock market and when these equity markets start to turn. Because historically, if you just go by this, we have room to run. That does not mean we're not already in a recession. It just means that the market's already priced in the weakness that we've had so far. And they have not priced in potentially anything else that's underlying. And they're going to go into rally mode for a little bit until the markets start to see that. Until the markets start to see perhaps a major bankruptcy somewhere. Again, that is just how I'm reading the charts for right now. If the bank failures get worse, this thing can seriously just maybe stay above for a little bit, rally, and then we start to just go down in shorter order. And it doesn't have to rally all that way, but we should get some type of pop where, this bullish channel stays intact, right? And you're going to get a good short. You should get a good short opportunity, or at least a great risk reward for what's coming. I think I will be adding shorts up in this zone and probably just stopping out. Probably playing put options like a year or two out and just writing them off. If I end up being wrong, and just doing it that way because you want to give yourself time on the clock in case this thing really just starts to blow off, right? This thing just starts to blow off and go up here, maybe make a new all-time high, and then come back down during the presidential election or perhaps after it if it wants to really go that long. So anyway, guys, this is great stuff for macro. And as far as the Lazy Day Trader channel, let's just get into a couple different things. We had a great Friday, and we're at a 90% win rate on day trades, where I'm showing you throughout the day how to navigate these markets so you can focus on what you feel is the best risk reward setup for your day trading. If you're trying to make extra income in the markets, if you just are trying to understand how markets move intraday, and then as well pull back into the nightly videos that I come and present to you and decide where swings and where levels might work out in your favor. So on Friday, I had one lazy day trade FDX. It did not hit its target, but it was very, very close. I want to call out here, we will likely have a SPY long, and this was at 9 a.m. I called out a level that worked out for about $1 in the pre-market. So I'm not adding this to the track record, but I am giving action to those traders who were interested in taking maybe a pre-market trade. One thing that I want to call out here is the SPY needs to stay above 393. This is very important from an intraday perspective because what you would see if you go to the intraday chart could not stay above 393. Now, if you're an aggressive trader, you could take that information and try to ride this down. It's not the easiest thing, and it's not what I'm calling out as a dead set trade for the room. But traders look at this and go, yep, that makes sense to me. It can't stay above. I'm going to take the long ride down, perhaps with a smaller share size or whatever you're comfortable with. You certainly could have done that. Now, going back in 10 or 20 points lower, what happened? Let's go back to the chart. 10 points, boom, 392, and then 20 points, 391. So there you go. You have your risk reward set up. Now, I had said, let's go back into the room here. I had said the first place for a long setup will be around 389 to 388. Boom, right here, 389 to 388. We have some divergences out there, right? So the Russell is down on the day, and that's showing you that the SPY should get down there. So let's take a look at, and I like to post memes in there, whoever's familiar with that meme. But here we go. SPY long, 391 to 390.50. They got to 391.08 and bounced. And that, whoever front ran that got paid. So again, not something I update on the track record, but traders could have made some money right there. And then it kept dripping down. Okay, so where is it? 389.50, 389. It's a tight spot. Let's load it up. And here comes SPY. Nice trade. 75 cents, 90% win rate, just painted by the numbers. Okay, guys. So I hope this is helpful for you. We're going to continue doing this. And then as well, going to be showing you the macro perspective because this helps as well for our thesis for certain day trades as well as swing trades, which I'll provide some ideas in the channel as we come along. But again, guys, go back, look at history on the yield curve spread for macro, take a look for yourself and see how much we really have to run here moving forward on a lot of these things. And that was my thesis on Bitcoin, getting all the way back up to about 53K. Okay. If we decide to do this blow off type of echo bubble melt up, that could certainly happen before ultimately we start to turn down. So have a great Sunday, everyone. Just wanted to get this video out there. Looking forward to seeing you on the charts and see you tomorrow bright and early. Take care.